Welcome back to another episode of DIY Money.
DIY Money.
What's shaking, Howard?
Same old. I got my garden in last weekend.
Wow.
And now it's raining every day, which...
Is that a good thing?
Yes.
But you can't... Do you get too much water? Is that a bad thing?
You know, I don't know. I was told water once a day, and when it rains every day, that's watering once a day. So it makes it easier on me.
Fair enough.
But from my understanding, and this... Someone out there is going to be like, you're an idiot. And that's fair. I know nothing about gardening. I'm not going to pretend to, and it's probably going to be a disaster.
Yeah, okay, hold on. But you say you know nothing about gardening, and you came in, you're like, yeah, we did a 40-foot bed of garden.
Yeah, that's what I mean.
Why would you go 0 to 1,000?
Because that's what I do, Logan.
Jeez.
It's a 28-foot bed, 28 feet long, 3 feet wide. I planted
28 feet?
half of it with seeds, and the seeds, I think, my understanding, again, we'll find out if this is true or not. I think seeds you really can't water enough. Like, they love to just have as much water as possible. You want to keep them, like, wet the whole time. Then once they root, then it's, like, once a day. But then I've also read sometimes it's better, like, 3 times a week with more water. I don't know what I'm doing. But I go out there with the hose, and I just beam. I'm so excited, and I'll just stand on the corner and water my plants, and the neighbors will walk by. I've met a lot of neighbors the last few days. And that has been really fun.
This is a pretty amazing transition that you're going through, Allie. You're going from, like, what you do as a 20-something-year-old to what you do as, like, a 70-year-old something.
Yeah.
Because you're also,
there, yeah.
in addition to now having 90 square feet of garden, you are also having, you're in a bird watching club now, I believe?
Not yet. I'm waiting for signups.
But you're waiting. I'm waiting for signups.
It's gonna be a
Don't you just go outside and watch birds? Like you have to sign up.
You can bird watch for free, but this club is exclusive.
How do you have a club for bird watching? I'm so confused. Do you wear a visor too?
I'm not. We've talked about the visor, Logan. That's sensitive. I'm not in my visor era yet, but I fear I'm on my way. And by fear, I mean I'm excited about the fact that I'm on my way. So my church over the summer, in efforts to, I think, make intergenerational, like, relationships where you're not just with people your age, they have what they call affinity groups.
Okay.
And so there's different things. So they might have one for board games or bonfire or hiking or chess. Like, they had a chess one. This year, and I hope this is real and they didn't just make this up on the stage, they said they were having a bird watching affinity group.
Yes.
That's where I want to be.
So you went from, like, I like birds to I will join a bird watching affinity group.
Oh, 100%.
Fair enough.
And I won't know any of them. Like, I know 3 to 4 birds at this point.
Yeah.
But think about who else is going to be in that group. And need I say more?
I don't understand.
Like, that group is going to be awesome. Some of the most fascinating, like, people watching kind of people. Like, you know there's going to be characters.
There's no one in that group under 70.
That's the point. That's awesome.
Fair enough. That's your group.
If you join, like, the chess thing, it's probably going to be, like, a lot of younger people.
Okay.
And then some old men. Like, for the most part.
Fair enough.
Bird watching is going to be me. And then
in your visor.
Middle-aged women in their visors. Not me in my visor. And then older men. That's what I'm hoping for.
Fair enough.
I can't think of anything I'd rather do more than go bird watching with some older people.
Fair enough.
See what happens.
Well,
I'll learn so much.
On that note, let's take a break for our sponsors. All right, welcome back. Make sure you check us out on the socials, DIY Money Podcast on most of the socials out there, DIY Money if you're on Instagram, as well as check out our website where you can sign up for the DIY Money Daily, where you can get a once-a-day update on the markets, what we're seeing, what's going on in the world. Check that out. You can go to DIYmoney.org and sign up online. And again, it just lands in your inbox. It's almost like the Morning Brew or something like that, but I think we do a good job of keeping it very concise and just giving you a little bit of insight. Allie, what are we talking about today?
Yep, so since this is a Friday episode, we're going to go back to the classroom to a concept that I think many people know very little about, very complex, but the idea of bonds. So we talk a lot about the stock side. In my opinion, that's the more exciting part.
Sure.
There's seemingly lots of different types of stocks and companies and earnings and all the things. But then you have the bond side to round out the portfolio. So in general, we get this question a lot in our office: are bonds a good investment? So I'll kick it off because you are by far, of the two of us, the bonds expert. It's certainly not something I have a ton of deep expertise on, but I think in general, most people should own bonds to some extent. So this is part of your global allocation. So remember, unless you're very young and have a very long time horizon, most people don't need to be fully invested in stocks, because it's nice if you're retired, for example, on the days that you turn on the TV and it seems like the world is ending and the stock market is crashing and all the panic, to know that there is a portion of your portfolio that is safer, and have to be really careful to not say safe, so there's still risk in bonds, but safer in that there's going to be a lot less volatility on a daily, minute, or second basis in a bond as there are in things like stocks, or there are other investment what's the word? Classes. There we go. Got there. So in general, I would add, typically, and you can fill in the gaps as why this doesn't always play out that well, you can almost think as bonds also adding some stability to a portfolio, because it often operates like a teeter-totter. So if stocks rise and are on the up and up, then bonds tend to perform worse. And then as bonds perform better, stocks tend to do worse. Now, this is an interesting time because that's not necessarily the case on a day-by-day basis, and you can talk through how this translates as we're cutting this today. But often what a bond basically is doing is following interest rates. So when we think about bonds, I often think about the Fed. And so the Fed has two goals when they're going and operating their interest rates. They want to keep inflation at roughly 2%, so keeping prices in order, and they want to make sure we don't have too much unemployment. So that's our two goals. And the way that they operate and manage those goals is by making debt, interest rates, more expensive or less expensive. So if they want to stimulate the economy, what they'll do is they will drop interest rates, because in doing that, debt is cheaper. So then you have a lot of companies that will go out, and all of a sudden it's a lot cheaper to improve and hire and build that warehouse and whatever else that might transpire. I am dumbing this down tremendously, but bear with me. So in doing that, they can get that cheaper. Fantastic. Well, what's interesting is the last couple of weeks, as we've been cutting this, there's been more and more pressure on especially long-term bonds. And so just this past week, bonds were at the 30-year, which is like the longest term for the most part that we look at. 30-year bonds were at the highest level they've been at since, 2000?
It's been about 20 years.
7, is that right?
Yep.
Am I quoting that right? So we're seeing this pressure where, okay, bond yields, meaning the interest rate that you'll get if you own a bond, are getting higher. What does that mean for overall economy? Again, going back to the teeter-totter, that means bond yields are higher, bonds are better, stocks do worse, right? But that's not always how it trickles out. So I'll let you jump in. You can add some color there. But I think as a general rule of thumb, what the average investor needs to know about bonds is that they help add stability to a portfolio because they're less riskier in nature than stocks. They still have some risk. And that oftentimes they are directly impacted over time by what interest rates are, which is indicative of our overall economy and how strong our economy is or feeling to be. So
yeah, let's clarify a thing or two too, because you mentioned the Fed and their control of interest rates. The Fed can only control the shortest term interest rates. So they basically control, this is not exactly how the operation works, but they basically control overnight lending rates between banks. So banks are required to keep an amount in reserve, their amount that is in the bank. It's about 10% that they have to keep actually in the bank overnight, because banks lend out money to various different places. The Fed controls the overnight lending rate if a bank gives out too much money and then they need to borrow from another bank to have money for their overnight. They don't control those long-term rates that we're talking about. So a 20-year treasury bond now being at over 5%, which is pretty crazy. That's, again, 20-year high for the interest rate, which also means that the bond value is very low. So let's back up a couple steps, though, because saying bonds are good for a portfolio is like saying music is good, right? Like, some music is good, some music isn't good, and it depends who you are if you like it, right? Like, I really like country music. Some people think country music is the worst thing ever. And, you know, my cousin Eddie's music is not very good, right? So, like, there's all of these different bonds out there. And a bond is just debt that a company or a government has sent out because they need to fund something. So, the number one debt provider in the world, take a guess.
Let's see.
United States. Yeah, the United States. So we are the number one provider of debt, meaning we have sent out debt. So if the government wants to fund something, where do they get the money? They get it from taxes, first of all. But then if they don't have enough money, tends to be the case, they have to sell bonds. So they might sell a $1,000 bond to you, Allie, directly from the government. You buy the $1,000 bond and you go, hey, if I'm gonna give you my $1,000 or I'm gonna give you $950 or whatever it might be, you're gonna want to return on that money.
Right.
So the government is gonna have to pay you for giving them that debt.
So it's essentially the same reason why when you give the bank your money, you often get interest back because they're borrowing your money. That's essentially what bonds are doing.
Yeah, exactly. Or on the flip side, you're taking out a loan. If you're taking out a loan, you have to pay the bank back for that loan. That is what the government is doing or a business is doing that takes out debt. So if they take out debt, they mostly do it in the form of a bond that they send out, and they sell those bonds. You pay money for them, and then they pay you interest for owning it. So they're not all great. There's a lot of different classifications for bonds, and I could go on and on. This episode could be 35 minutes long, but the different classifications can go from really highly rated, like a United States bond. In most cases, despite what the news headlines are going to tell you, the U.S. is going to pay their bonds. Like, they are going to pay the interest on their bonds over time, unless the government goes out, which would be catastrophic and crazy. But then there's also this small niche company that my cousin Eddie has that he sells debt for. You might not get that money back. And some of those bonds can be classified as like junk bonds or high yield bonds. They're going to pay you a lot because you're going to tell cousin Eddie, hey, cousin Eddie, if I'm going to give you $900, you're going to pay me a whole heck of a lot of money for that because you're probably not going to pay me back.
Yeah, so they're going to get a grade.
That's
so bonds will have grades. It might be AAA. If it's the best of the best, you have little concern about getting your money back. And then when you get down in the junk bonds, people start to wonder if they're going to get their money back. So that you're going to get exactly what you said. You're going to want more interest to take on more risk in that. So that's where bonds do have risk. Don't listen to people who act like they're safe, because depending on what bond you own, you may or may not get that money back. Yeah, so then bonds pay in two ways. Typically, they pay out a coupon. So they pay you a little portion of money that they give to you for holding on to that debt. And then they also can appreciate over time, so they can grow in value. But typically, for our investors out there, just like most investors don't own individual stocks, most investors don't own individual bonds. They're not going out and buying one U.S. Treasury bond or Microsoft bonds or whatever it might be. They're owning a basket of those bonds. So like the BND is a world bond fund, is an aggregate bond fund, or you could buy just U.S. Treasury bond fund. That's going to own thousands of bonds in that category, and it's going to move up and down based on interest rates and based on the value of those bonds moving up and down, just like the teeter-totter you talked about. But bonds have a place, just like a lot of investments. They have a place in a portfolio, and it's to do what you said. It's to reduce risk or reduce volatility. Now, that is a technical term that investors throw around all the time. It just means the ups and downs. It's supposed to reduce the ups and downs of your portfolio. So it's great on the downside. Bonds are great to have in your portfolio. If the market goes down, you hope that the bonds do okay, or at least don't go down as much as the stock side of your portfolio does, or the equity side of your portfolio. However, on the other side, if your stocks are increasing in value, this is what has happened over the last few years,
Equities and stocks have increased in value significantly, and bonds haven't done so much. They've kind of stayed relatively where they are, or actually gone down in a lot of circumstances. So having it as part of your portfolio is having an appropriate allocation. So it's not cookie cutter. A lot of the time people decide their allocation, their stock versus bond mixed, based on their age. So that's kind of your first factor, is age. Second factor is like life circumstances. So, Allie, we say 5 years or less, don't invest. Well, don't invest means a lot of things, but it means definitely probably don't invest in equities. And if you're going to invest in something like a bond, do it in very short term. So you know you're going to get money back. Same thing with like a CD.
Yeah,
you know, you could have a short term.
Interrupt you for a second to clarify. The reason why is if you hold a bond to maturity, you're not worried about the price. So you mentioned a moment ago, there's two ways you can make money on bonds. One is the appreciation of that bond. So for example, if you buy a bond at $990 and you hold it to its full maturity, you're probably going to get $1,000, which is the face value of the bond. So over time, you're making money similar to stocks in that over time they're worth more. You often get that discount on the front end, at least with most bonds. They don't always work like that, as does never anything in the financial world is never that simple. But that's the first portion. The second is the interest they kick you off over time. So again, they can kick it off a number of ways. Often it's quarterly, sometimes it's monthly. It kind of depends on what bond that you own, but that's similar to interest, and that's called the coupon rate. Right. So you earn money through the appreciation of the actual bond. However, if you're holding it to maturity, meaning you have it, if you have a 6-month bond, you wait the full 6 months, you don't cash it out early, then you're probably just going to get what you anticipated at the beginning and not the way it's moved along the way.
Sure. So in that 5 years or less, again, don't invest. If you're outside of that time period, you have to think about your life circumstances. So if you know you're going to need something in 10 years that you're going to need a portion of money for, you might not be 100% stocked invested in that. You might be backed off. You might have a portion of that in stocks and a portion of that in bonds to keep a portion safer and then a portion a little bit more aggressive. So the typical equity risk, stock risk, is higher than the bond risk. We're talking about the differences between those two. So again, age is an important factor when determining your allocation. The next component is that making sure you look at your life circumstances. So your retirement accounts might be allocated different than your house fund that you're going to need in 10 years. The third thing, and I think maybe the most important thing, is what your tolerance is, your risk tolerance. Are you the person that when the market goes down, you start worrying about, oh my gosh, are my kids going to be able to go to college? Or, oh, I'm going to have to work extra years because the market's down right now. To the point where you feel you might make a bad decision or you consider selling at a poor time. And if you have that, you have to know yourself. When you get punched in the face, when you have a March like we've had this year, are you trying or even thinking in your mind about making a poor decision? You're probably over allocated in your investments. We have an 82-year-old that has hired us in the office that has said, I never want to own a bond. I want to be aggressive. I'm okay with the fluctuations that stocks have. I don't want to own a bond. At the same time, we have people that are in their 30s that are saying, I don't like as much fluctuation as the market has. I want to have some bonds in the portfolio too. So allocation is not just age, but it is a factor. And what typically happens is as you get older, you're backing off the risk. Your risk tolerance goes down a bit because you need the money. And having some stability or at least less ups and downs in your portfolio makes a lot of sense as you get older. So are bonds a good investment? Again, that's like asking, is music good? It might be for you in your situation. It might not be. It's determining when the time is to add bonds to your portfolio and making sure that your allocation is appropriate for where you're trying to go and what your goals are for retirement or for saving for a big goal or for buying a house or whatever it might be.
Yeah, absolutely. Well, nothing else to add. We will wrap it there. So thanks for going back to the classroom with us today. Remember, the secret to wealth is very simple. Live on less than you make, invest the rest, and do so for a very long time. Make it a great one.